Hi, so welcome to the stream today and welcome to a brand new week as we continue with our discussion for the November 2025 examination. Just some quick updates, then we will get excited into the discussion. Today, officially, the examination, our registration for the exam has commenced. So if you are ready and you want to register for the exam, you can just visit your ICAG portal and you'll be able to register for the exam. But you have from today, 8th of September 2025, up to the 17th of October 2025. So you have some time to go to help you to really conclude on which subject you should go for, what combination you should go for based on the time and availability, and as well as the pressure that you are going to be handling in the course of that examination week. So registration has commenced and you can start registering now. Just so you know, I mentioned this in the previous session. If you're somebody that is now coming in and you have been given exemptions, you would have to pay all your exemptions before you'll be able to get access, or your portal will be open to register for the examination. So you just bear in mind, there is no way you can skip the subscription or payment of your exemption fee to register for the exam. Everything is integrated, so you just have to bear that in mind. But once you have your subscription and everything paid, you'll be able to register for the examination. If you have any challenges or any issues, certainly you can reach out to the ICAG and you will be assisted. Also, our registration is currently still ongoing. We are in session 5 or the 5th week. We are starting the 5th week today. So if you are somebody who is planning to sit for the November 2025 examination, you can still register to join our class. Our lecture videos are recorded and accessible on our website as well as in the Nhyira Premium mobile application, which you can download on the Google Play Store or the Apple App Store and get access to the content, be guided, be mentored, and provided with the assistance you need to pass the examination. There are a few announcements that we're going to be making on Friday as well as on Saturday, so you want to stay tuned for that update because it's going to really help you to put you in the position as you are preparing for the examination. Also note that we have our books available, so all of the books that you would need: public sector accounting and finance, taxation, management accounting, advanced audit and assurance, financial reporting, corporate reporting, strategic case study, financial management. We have all these books available, and if you want some copies, you can certainly reach us 050-114-9296, and delivery will be arranged for you so you can get access to these books. One of the things about our books is the number of questions we have in the book and how practical it is in respect of the way I present, the way I teach. That is the same way these books are structured, so that it helps you to really go through the syllabus in record time so you can put yourself in the position to pass the examination. Our discussion today is going to be focusing on the IFRSs. So far, if you have been following the discussion in the in the session 1, we looked at a couple of accounting standards there. Sorry. Give me a sec. Okay. I think we're good. In the session 1, we looked at a couple of accounting standards there, and that included IFRS 9, financial instrument. Then we looked at IAS 23, borrowing cost. We also spent the time to consider some issues in respect of IAS 2, inventories. And so that was what we did in session 1. If you miss any of these sessions, you can check the IFRS Masterclass podcast on the YouTube channel, and you'll be able to get access to watch the playback of all of these videos. Then we got excited into session 2, where we dealt with government grant. And then we came to the issue in respect of IFRS 15 again in the discussion there in respect of how revenue is recognized. Then we spoke about IAS 8, accounting policies, changes in accounting estimates and errors. In the discussion today, we're going to be getting excited to look at still some questions in respect of the accounting standards, focusing on IAS 37, provisions, contingent liabilities, contingent assets, and then IFRS 15, revenue from contract with customers, focusing on some of the past questions coming in from the ICAG. So let me bring up my screen quickly so that we can get excited into the discussion. If there are any questions you have, something you want to pick my brain on, you can put it in the comment section or the chat for me, and I will be able to read and provide you with any answers. Remember to like, subscribe, and share the video, okay? Share the video on your WhatsApp pages, on your Facebook pages, on your Telegram pages. Just share the video. Let's reach as many students as possible and help many people who are preparing for their financial reporting and corporate reporting examination. On the overall, there are various contents we have available on the portal that you can get access to, and so make sure you share that as well. So let's get excited into the discussion today, and we are going into an ICAG past question, and that is the July 2025 examination, and we are looking at corporate reporting, July 2025 examination, corporate reporting, and we are getting ourselves excited into question 2, where the accounting standards are, and we're going to be picking some of the accounting standards here and crystallize some of the principles here. So we have IFRS 15 on the A aspect of the question. We have IAS 33 on the B aspect of the question, and then we have IAS 37, which is on the C aspect of the question. Then D is IAS 41, agriculture. So 4 accounting standards for 20 marks. That's the examiner brought in the July 2025 examination. So you can download this question on the ICAG website, July 2025. It's available there and want to go into it. So let's start with the A aspect of the question. That is going to be on IFRS 15, revenue from contract with customers. So let's go into the discussion. For 8 marks, now I want you to always be mindful of the fact that if the question is 8 marks, 1.8 times 8, that is 14.4. So give and take, you're supposed to use 15 minutes for this question. And that 15 minutes includes reading, working, extracting whatever financial statement that the examiner wants you to extract. So let's see how we present this in this particular question. Required. In accordance with IFRS 15, revenue from contract with customers, show how the transaction described should be accounted for in the financial statement of Gold Key for the year ended 31st May 2024. Okay. So we know that when it comes to the IFRS 15, by default, we go with a 5-step framework for revenue recognition. That is identification of the contract with customers, identification of performance obligation, which is what the entity is required to do under the contract. We determine the transaction price, which is the amount received or receivable by the entity under the contract. Number 4, if the performance obligation is more than 1, then we allocate the transaction cost to the performance obligation using their standalone prices. Then number 5, which is the end, is where we recognize revenue as or when performance obligation is satisfied. So that is the 5-step framework for revenue recognition in accordance with IFRS 15. Revenue from contract with customers. But it is important you know that under that umbrella, under the umbrella of IFRS 15, there are a number of things there, one of which includes where we are dealing with construction issues and performance obligation is going beyond 1 accounting year. And that is the environment that this particular question is in, and we want to look at it and see how we can provide some answers here. So let's go back up to the question. Gold Key Properties. Gold Key is a leading real estate company dedicated to delivering innovation, high-quality property solutions across residential, commercial, and property management sectors. It is currently preparing its financial statement for the year ended 31st May 2024. Okay, so Gold Key Properties. Put the name of the company up so we can get excited into the discussion. So Gold Keys Properties. Is it key or keys? Key, okay. Not keys. Okay, Gold Key. Okay, I get it. All right. So let's go. On September 30th, 2023, Now, if the year ended is 31st May 2024, then the year starts on 1st June 2023. So the year starts on 1st June 2023. Now, I always tell you that year ended is very important when it comes to dealing with the financial reporting, corporate reporting, preparation of financial statement, treatment of the accounting standards. Because if you are not careful about the year ended and the period under review, that is going to have an effect on your answer, which means you're going to walk away with Zokbo and you're going to be getting 0. So on 30th September 2023, Gold Key and the Council of the Institute of Chartered Accountants Ghana, ICAG, entered into a contract to build a 4-story auditorium for ICAG. Okay. So our company is the contractor, and so that is why IFRS 15 is coming into town. So the idea is going to be how much revenue or how should the above transaction be recognized in the books of the contractor, which is Gold Key Limited. Below is a summary of the terms and conditions for the agreement to construct the property. ICAG paid a non-refundable deposit of 4.8 million to Gold Key, and Gold Key began work on the construction on 1st December 2023. Now, it is important to understand that when it comes to dealing with the transaction price, or on the flip side, the revenue under IFRS 15, in certain circumstances, we're going to have fixed revenue coming up, and then we're going to have variable revenue coming up. Normally, fixed revenue means the entity will receive that money irrespective of the outcome of the contract. And so when we are calculating the revenue of the entity for the year ended under review, that fixed revenue will be included or will be recognized. The variable revenue will be the additional revenue that the entity is going to be receiving, subject to meeting certain conditions. Okay? So this is subject to meeting conditions. Why is that important? Because it means that we need to set the tone up for the revenue that they expect to generate as an entity. So expected revenue. We're slashing our currency sign. Let's see, 4.8. Let's tell the examiner we like to work 3 zeros up to keep things simple, okay? So now they said a non-refundable deposit. So we bring that in, the initial deposit, and that is an amount of 4,800 Ghana cedi, or 4.8 million, right? Let's continue to read. ICAG will make the following payments. Stay with me. Okay. 6.4 million on 31st May 2024 when 30% complete. 6.4 million on 30th November 2024 when 60% is complete. 8.8 million on 31st March on completion and transfer of the facility. So these payments that are going to be coming are variable payments. The question we want to ask ourselves is, can we include all of these as part of the expected revenue that Gold Key Properties is likely to get from the ICAG? The answer to that would depend on, especially the last one, when they complete the work. So let's go to note 3 and see if we can build up the story as we continue. There is no significant financing component in the contract. The reason why that is also important is that if there was a significant financing component, then possibly we have to discount the money into present term and then calculate the finance cost on it so that the present value becomes the revenue that can be recognized. Then the unwinding becomes the finance income that will be recognized in the financial statement. That's a critical principle, because when someone is supposed to pay us in advance, at later date, and there is a significant financing component, then we have to discount the payment into present terms so that that present value becomes the amount of revenue we recognize. The finance income will be the unwinding, because anytime people make payment in future like that prior to us finishing the job, after we finish the job, it means that there are two components in that payment: the finance component and then the revenue component. Here, we are told there is no significant financing component, so no need to discount any amount, no need to calculate for any finance income. And the project is expected to be completed within 18 months in compliance with ICAG's instruction. Okay, so it means if you're able to finish the project in 18 months, you get your money. Let's go. If the facility is not completed and transferred to ICAG by 31st May 2025, then the final payment will be reduced by 800,000 for every complete month after 31st May 2025. Oh. So it means that final payment of 8.8 million, which is receivable upon completion, is conditional. It's conditional. Now, as we build the story up, we could then come and conclude here and say, okay, so this is initial deposit on. When did they get the initial deposit? That was on 1st December 2023. So first D's 2023. Then let's continue. 6.4 million on subsequent years. So variable payments. 31st May 2024. That is giving us an amount of 6,400. Stay with me. 30th November 2024. We will also get 6.4 million if the job is 60% complete. But now, on the next one, which is 31st May 2025, that is subject to meeting the conditions. So let's continue to read whether that payment will be reduced by the 800 or not. So the management of Gold Key have the following additional estimate. So let's go. Plant purchased by Gold Key for 12.8 million on 1st December 2023. Remember, 1st December 2023 was the date they commenced the construction, that the construction work started. Would be used exclusively on the contract with ICAG until its completion. Then used on other contracts. Okay. Now, as per IFRS 15, when an entity buys an asset and is going to use that asset exclusively for the construction or execution of a project, then the depreciation of that asset must be included in the cost of the contract. Let me take that again. If they are going to use their normal assets that they use for all projects, then that one will be accounted for in accordance with IAS 16, and we charge depreciation. But if they bought an asset, that will be exclusively used for the project under review, then depreciation on that asset must be calculated using or calculated and included in the initial cost of the project. That's very important, and we're going to be coming back to that in a moment. At the date of purchase, the estimated useful life of the plant was 5 years. At the date of the purchase, the estimated useful life of the plant is 5 years. So quickly, this could be my workings 1. The expected revenue. Then I'll come to workings 2. Just make sure that you are living a reasonable space. Cost incurred to date on the project. So we go in there and we bring in the asset. Now, life is 5 years. Stay with me carefully. Our year ended is 31st May 2024. So they started the project on 1st December 2023. So December, January, February, March, April, May. 1, 2, 3, 4, 5, 6 months. 6 months. So if we check the cost incurred to date, the depreciation of the plant is going to come in. Now, there is something, let me highlight that quickly. It says, then used on other contract. So this plant will not be just for this project. Again, let me just draw a thin line there. If the plant was just for this project, then the whole cost of the plant will be included in the cost of the project, less any residual value on the asset. But here, it will be used exclusively for the ICAG project. Then after that, it can be used for other projects as well. So we will only consider the depreciation relating to the plant as it is used for this project. Principles. So depreciation, the amount there, 12,800. Economic useful life is 5 years, 6/12. All right? So 12,800, 5 years, 6/12, and that is 1280. So that is the depreciation for the project so far. So far. Stay with me. Let's continue to read. Second, estimate by the entity. Gold Key will incur material and direct labor cost of $960 per month to fulfill the contract with ICAG. Okay, $960,000 per month. So we bring that up. Direct material or material, and let's use the words they used. Materials and direct labor cost. So materials and direct labor cost. That is 960 times 6 months. Because remember, up to the year ended we are looking at cost incurred to date. So 960 by 6, that is 5760. Let's continue to read. The cost will continue and at this rate until the facility is completed. Okay, so throughout the 18 months, they expect that they'll be incurring that cost. But remember, we are interested in cost incurred to date, so the remaining cost, we don't know because things can change. Then the last sentence, there are no inventories of unused material at any time. Now, if there were inventories of unused materials, which would have been sent back to the warehouse, they would have subtracted that from this 5760. So the concept then is that the materials bought, inclusive in this 5760, have all been consumed or used as at the year ended. Again, if there are some materials bought for the project that have not been consumed yet and have been returned back to the warehouse, then if you are looking for cost incurred to date, it has to be excluded so that we will look at it as probably part of cost incurred to completion if we have to consider that. Materials which had been purchased for use on the contract with the ICAG were damaged due to negligence of Gold Key's employees. Okay. This resulted in Gold Key incurring a one-time additional cost of 1.6 million during March 2024 to rectify this damage. Okay. So some of the materials were damaged and they incurred a one-off cost of 1.6 million to repair that. The question we ask ourselves is, should this be part of the cost we incur for the contract? No. If anything, this 1.6 million will be written off in the profit or loss. Because these cannot be included as part of the cost of the project we are undertaking. Very important. So if anything, that 1.6 million will be written off in the P&L account. Last sentence in that second paragraph of the estimate by management. As a result, Gold Key now expects the facility to be transferred to ICAG by 15th of July. Stay with me carefully here. They now expect to transfer the property on 15th of July. Remember what we read earlier, that should they fail to bring the project to ICAG or transfer the project to ICAG on the contract date, 31st May 2025, every full month will require a reduction in that final payment by 800,000 Ghana cedis. So if you check, May is the day they are supposed to give the asset to ICAG. So June is a full month. July, they say now they will submit or give ICAG the asset on 15th of July. So July is not a full month. So a full month, the money they're going to lose will be for the month of June. What does that mean? It means that for the last payment, which is slated to be on 31st May 2025, they will actually get that money on 15th June, subject to a reduction of 800,000. So we're going to change this date to 15th of July 2025. Yep. 2025. And they won't get the full amount they should have gotten, which is the 8.8 million. So 8,800. So they're going to be losing the full month 800,000 so that they will get only 8,000 in that final payment as per the contract. So these are variable payments based on the context of the question. The final sentence. The contract is expected to be profitable overall. Okay. So if they expect it to be profitable, we are interested in the revenue, we are interested in the cost of sales and those things, then certainly we have to calculate contract assets or contract liabilities. The contract is expected to be profitable overall. On 31st May 2024, which is our year ended, the contract was confirmed to be exactly 30% complete. Okay. So ICAG made payment due on this date. ICAG is reliably expected to make the payment due under the contract on 30th November 2024 on this date. Now, what do we mean here? Simple. We are done. IFRS 15, when performance obligation is going beyond one accounting year in an environment like this, construction contract, we don't recognize revenue based on the payment we receive. Revenue is recognized based on what? The percentage of completion. So let's go clean it up. Let's see the total revenue that they expect, which can also be called contract value on the project. So we add these up. The fixed payment, 4,800. They've already received that, 6,4, 8,000. And that is 25,600. Okay, 25,600. That's the idea there. And so if that is the contract value, let's see the cost that we have incurred to date. 1280 plus 5760, and that is 70. Yeah, 70/40 for us, which is the cost incurred to date. Okay, so now remember the requirement of our question. Show how the transaction described should be accounted for in the financial statement of Gold Key. Okay, so now we can go and say, hey, how much revenue can we recognize? So the revenue to be recognized will be based on the percentage of completion. At that date, at the year ended, we've done 30%. Revenue or contract value is 25,600. So let's see how much we got. 0.3, 25,600. And that is 7,860. So that's the revenue that we recognize. But a question you need to ask yourself in the context of this question is, okay, if you look at it so far, how much money have we received from ICAG? Our company has received the initial deposit of 4,800. Stay with me. And they have also received that 6,400, which is supposed to be wired. Because if you check here, it says, so ICAG made the payment due on this date, which is the 30th May 2024. So the 30th May 2024, as we've done 30% of the job, ICAG has paid the 6,400. But remember, they made an initial deposit also of 4,800. So the payments we have received from ICAG, so payment from ICAG will be the initial value 4,800 plus the money they paid out on the 30th May 2024 6,004. I'm fighting a little bit with the year issues in the context of the question. Okay, we are in 2024. Okay, then no problem. 6,400. So the money ICAG gave us will be how much? 4,864. And that is 11,200. Okay. So we've received 11,200. We have incurred a cost. Sorry, we are supposed to recognize a revenue of just 70. So the question we then have to ask ourselves is what's happening here for the period under review. So the value of the work we've done is 7,860, but we've received 11,200. What does that mean? That means that we have received more money than the value of the work that we have done based on the percentage of completion. And so the excess amount will be dealt with as a contract liability. That's the idea here. The excess amount will be dealt with as a contract liability. And so the difference between this will be contract liability. So 7,860, 11,200, and that is going to give us an amount of 860 minus 11,200, 3,520. And this contract liabilities will go in the books under current liabilities on the face of the statement of financial position. Then certainly this is going to go in the profit or loss as revenue. All right. Then what will go to the P&L is the cost we've incurred to date so far, the 7,040 plus the 1.6 million. So amount charged to profit or loss will be the cost incurred to date. Normally, that will form part of cost of sales in the P&L account, which is 7040. All right. Then the 1.6 million they incur for the repair of the one-off additional cost to rectify the damage on the material. So material damage rectification, 1,600. Now, normally, again, we could put that also in cost of sales if we want to, because it's part of material cost that we are incurring. So it could be part of cost of sales as well in the statement of profit or loss. And so in total, 7040 plus 1,600, and that is 8640. This is the workflow for this particular question. Revenue from contract with customers and how we go about this question. So again, just quickly, the total revenue from the contract, depending on the terms of the contract available, now we have the fixed payment and then the variable payment. Now, because they are likely not to meet the deadline, there is a 1 full month. That's the condition in the deal. So they are losing 800,000, thereby getting they are likely to get just 25,600. Cost incurred to date. The plant was bought and will be used exclusively for the project. So the depreciation on that plant will be coming here as part of the cost incurred to date. As I mentioned earlier, they will use their plant exclusively for the ICAG project, but when they are done, they will use the plant also for other projects. If the plant was bought exclusively for this project and after that they will not use it for other projects, then the cost of the plant, less any residual value or scrap value, would have been what we will include in the cost of the project. So you got to be careful about that treatment. Then certainly revenue recognizable, which must go to P&L as part of revenue, will be based on the percentage of completion of the contract value. And so 30% of the 25,600, 7,860. And then we bring in the payment from the ICAG. We've received more than how much we can recognize in our books, because 30% complete is like work certified. So the work certified is 7,860, but the ICAG has given us 11,200. So they have given us more money than the value of the work that we have done. And so the balancing figure becomes contract liability, which means we owe ICAG under the contract. So that is going to be under current liability. And then certainly the cost we incurred to date plus the damage rectification to the material will then be written off in the P&L account as part of the cost of sale. That is the idea about this question, and that is the answer to this question. So for 8 marks, you are supposed to do this in 14 minutes, at most 15 minutes, if we want to extend it a little bit. And that is the idea about that. So that is another aspect of IFRS 15, revenue from contract with customers, that you have to be mindful of. I'm seeing some chats coming up. Let's see if I can look at them quickly. Moses said, watching live from Uganda. Thank you, Moses, for joining us. Big ups to you and everyone watching us from Uganda. Clement said, good evening. Is this your volume or I don't know what is that? Raphael said from Nigeria. Okay, Raphael, thanks for joining us on the stream today. Sinclair said, just joined. Greetings to you. Greetings. Watching from Zambia. All right. Thanks for joining us on the stream from Zambia. So we have Uganda, Nigeria, Zambia, and then certainly the homeland Ghanaian. Michael Ashley, please, how about half a month in July? Are we not subtracting 400,000? Did you read the context of the question? You are not working just for working's sake. You are working based on the context of the question. The context of the question said here, then if the facility is not completed and transferred to ICAG by 31st May 2025, then the final payment will be reduced by 800,000 for every complete month. That's the word. Every complete month. So 17th July is not a complete month. The concept is every complete month. And so the only complete month we have is June. So you can't say, oh, 15th of July, so let's take half of it and do 400. No. We can't do pro rata. It says every complete month. So the 800,000 will only be deducted by ICAG if it's a complete month. That's the concept to the question. So we are not going to be subtracting any 400 from the workflow. All right? We are not going to subtract any 400 from the workflow. That's the idea. We'll subtract the full month for June, 800, and then that is all. So that is the idea about that. What else do I have? Give me a sec. I think some of my slides may not be coming up. Okay. So let me bring back my slide then. All right. So that's the question A aspect of the question for us, IFRS 15, and how we account for it. So let's go to C for us. C. C is 4 marks. So 1.8 times 4 is 7.2. So at most, this should be done in 8 minutes. Again, that time is inclusive of reading, writing, calculating, everything. 8 minutes. Let's see what we can do here. Requirements as always. In accordance with IAS 37 provisions, contingent liabilities, contingent assets, show the accounting treatment of the above transactions in the financial statement of Jampo Limited. Jampo Limited. So, Jampo Limited, the accounting treatment. Okay, let's go back up. You are the director of finance at Jampo Limited and a chartered accountant. You are finalizing the financial statement for the year ended 30th September 2024. So that's our year ended, always crucial for us. There is a provision of 500,000 Ghana cedi shown in the draft statement of financial position, which relates to outstanding lawsuit for the supply of faulty product prior to the year end. Okay, so I need you to understand what is going on here. So prior to the year end, so it means balance brought forward on provisions 500,000 / currency sign 500,000. So prior to the year end, this is a provision that we are going to be making. Or that is outstanding. So that's the opening balance. Let's continue to read. This amount has been recognized as a provision based on advice. No, let me take that again. Prior to the year end by Jampo Limited to a number of customers. This amount has been recognized as a provision based on advice from Jampo Limited's lawyers that the claim are likely to succeed within the next 6 months. Okay. Which has led to some adverse publicity. The products were withdrawn in August 2024. All right. So this is the opening balance for provision in terms of a lawsuit. And the lawyers are saying that, hey, it's likely that they will succeed and we have to pay them this 500,000 Ghana cedi. So that's the opening balance. Second paragraph. Since recognizing the above provision, Jampo Limited discovered that there are additional 50 faulty products still in circulation. Okay. Jampo Limited lawyers estimated that for each product, 350 Ghana cedi would need to be paid. And so we are estimating provisions. And lawyers are saying that, hey, yes, you withdrew the products in August 2024, but 50 of the products are still in circulation. Because we still have 50 of the products in circulation, each of them, you are likely to pay 350 Ghana cedi. What does that mean? It means that we have to make provision for that. It could be in a case of warranties. It could be in a case of repairs for them or something like that. So on the advice of the lawyers, this has to be provided for in the current year because it's a potential payment coming up for us. So we can say additional provision for product not withdrawn. And so 50 times 350 cedis, that's going to give us 17,500 here. So 17,500. Okay, let's continue. Last paragraph. During the year, Jampo Limited started offering a 1-year repairs warranty. Okay, that meets the recognition criteria, so we have to provide for warranties with its luxury products. If minor repairs are required for all the relevant goods sold, the cost will be 65,000 Ghana cedis, compared to 157,000 if major repairs were required. So 2 events are here, minor and major. We need a probability of them occurring, then we can get the estimate of warranty that we have to provide for in the current year. Jampo Limited estimates that 20% of the goods sold will require minor repairs. Oh, okay. Then 5% will require major repairs. No provision was recognized in respect of warranties for the year ended 30th September 2024, as no goods had been returned by this date. Okay. Warranties are not going to be recognized based on returning of the goods. No. Immediately the entity sells the goods, we have to make provision for it. And so for that reason, yes, no goods have been returned, and so they have not made any provision for it. But that is not a principle. We have to provide for it anyways because you have made the promise to your customers. So warranties. There are 2 scenarios here. Minor repairs and then major repairs. Minor repairs and then major repairs. So let's bring it in. Minor repairs, we are told, will cost 65,000. So they're going to put that in bracket, 65,000. Major repairs is what is costing the 157,000. The probability of them occurring, 20% estimate, and then 5% for minor. No, 5% rather for major, 20 for minor. So we multiply these up. I've written 50%. The thing is 20%. So 0.2 by 65,000. And that is 13,000. And then 157,000 by 0.05. That is 7850. Okay? 7850. So we have to make provision for that, because the rule for provision for warranty is immediately the goods are sold, you must provide for them. It is not when the person returns the goods and you incur the warranty cost, then you recognize it in the books. No. You provide for it, immediately sales take place. And we are done reading. And we are done. So if we look at additional, taking into consideration the amount pending there, let's look at the additional to see how much provision will be carried on the face of the statement of financial position. 7850, and that is 38,350. So you add that to the opening figure, and that gives you the balance brought down for the provision that will go under current liability on the face of the statement of financial position. So that's going to be 83,000. Did I say 83? 88 rather. 88,350. So that will go on the face of the statement of financial position under current liability, because provisions are normally going to be current liabilities. And the components there are lawsuits payable in 6 months' time, and then warranties. You don't know when the person will bring the money that you are supposed to pay the person, or the person will return the goods that you are supposed to pay the person. Hence, we just recognize it. So how much goes to P&L? Simple, right? At the beginning, we had 500,000 already provided for. At the end, the value is now 500 and... No, I think I'm making a mistake here. Give me a sec. This will be 538. 538,350. Yeah, 538,350. Got to be mindful of the arithmetics. So opening figure 500,000. Closing figure is 538,350. The difference of that goes to P&L account. So the amounts charged to the P&L, amount charged to profit or loss, and certainly that could be under admin expenses, or if you want to keep it simple, operating expenses, is the increment, which is the 38,350. 38,350. That is the idea about this question. Very sweet, simple, straight to the point. And that is why you have it there as just 4 marks. IAS 37, provisions, contingent liabilities, contingent assets. There is no rocket science in this question here. No rocket science in the context of this question here. So that is the C aspect of the question there. Then look at the D aspect, which is a written question for 3 marks. 3 marks. And I think I said this in the session 1, and I said it also in the session 2, that there are theories that the examiner is trying to test and sometimes wants to bring in that question 2 area. Now, that is different from the written questions that you are going to be having in the exam hall, right? That the examiner will be throwing at you in the exam hall. Because there are other theories that the examiner can throw at you on consolidation, on sustainability, on IT issues, and some other things. But you are also seeing that the examiner is bringing in some standards-related issue dedicated, okay, dedicated here in the question. And we saw that in the FR class or the FR papers that we looked at March 2025, July 2025. So what I'm trying to say here is that when you are studying, don't just be glued on, the calculation. Also be mindful of the theories. Because when you take any accounting standards, the objective of the standard is there, the recognition criteria is there, the initial measurement and initial recognition is there, subsequent measurement is there, disclosure requirement is there. The examiner can bring questions from all of these angles. Your responsibility is to be able to know and apply the principle based on the context of the question. That is what you must understand. So let's look at this simple theory here, the D aspect of the question for just 3 marks per the examiner's discussion here. Just 3 marks. So let's see what we have. It says, state the provision of IAS 41 regarding recognition and measurement of biological assets and agricultural produce in the preparation and presentation of financial statements. That's IAS 41, agriculture. And here the focus is on biological assets. And so this is not a rocket science. For instance, that recognition part, if you know your principles from IAS 16, biological assets are assets. So what's the recognition of assets? That we control it, right? The entity has control over the asset. Okay? That the entity controls the assets. That's the first thing. It is probable that future economic benefit will flow to the entity. And then number 3, the cost or fair value can be measured reliably. The cost or fair value can be measured reliably. That's it. Because it's an asset. So all forms of assets, whether inventories, investment property, intangible assets, property, plant, and equipment, all assets recognition criteria largely will form in this category 98% of the time. Right? 98% of the time in that particular case. Yeah, there are other forms of assets that there are certain accounting standards that we are going to be applying their rules specifically. Right? But biological assets is just like IAS 16, it's just like IAS 2, it's just like IAS 38, it's just like IAS 40. So recognition, do we control it? Is it probable that future economic benefit will flow to the entity? Can the cost or fair value be measured reliably? That's the first part of the question. The reason I am emphasizing on this is because sometimes questions are in 2 folds, and students will answer only one part of the question and leave the rest. But you got to be careful because this question is in 2 folds regarding recognition, and then certainly number 2, measurement. Now, when it comes to measurement of biological assets, the rule is very simple. Usually, biological assets are measured at fair value less cost to sell. Okay? That's simple. They are measured at fair value less cost to sell. Basically, if you understand your principles, measured at fair value less cost to sell. That is the idea there. And I think maybe we will, I wouldn't say we will go through the standard, but if you have access to our courses, we have videos on IAS 41, and you can go through the entire discussion on what these are, because here we are talking about, plants, we are talking about animals, how we account for those things. So you can go deeper into the standard if you want, and then watch the summary video in the mobile application or on the website once you are enrolled in our financial reporting or corporate reporting course. Under the summary videos, the principles of IAS 41 is available there, with even some questions that you can look at. But generically, what is going to be happening is that it will be measured at fair value less cost to sell. Then on subsequent measurement, on any remeasurement, any gain or loss on it will also be recognized in the P&L account. So that is the idea about measurement also for biological assets and agriculture produce. That is all about that, and that's IAS 41. Let me just show you something quickly about that. Let's see if I can pull those up real quick. Just giving you some one-liner definitions. I'm coming in from my book on financial reporting or corporate reporting. So IAS 41, agriculture, page 76. So there you go. So when we talk about biological assets, we are talking about animal or plants. Okay, agricultural produce are harvested products from biological assets. And that is the idea, basically, that you must understand there. And so if you see it, recognition criteria, which we have spoken about, we have control, future economic benefit will come to us. We can measure the fair value or the cost reliably there. And that is it. And so when it comes to biological assets, recognize at fair value at fair value less cost to sell there, so that any changes in the fair value on subsequent measurement recognizing the profit or loss. So very simple standard. But there are a number of issues there. As I said, you can watch the summary video on IAS 41 to understand the principles well, on detailed presentation on what is included in biological assets, what is included in agriculture produce, and how they are done. But generically, these are how they are going to be measured there. And that is the C aspect of the question for 3 marks. Written questions: what is the recognition and measurement of biological assets and agricultural produce in accordance with IAS 41 agriculture? So that's the idea about that. Let me see. Do I have any other questions coming up for me? Michael said, okay. I get it now. All right, that makes sense there. Okay. So those are some of the things that, what time will allow us today to bring to your attention. So we've looked at IFRS 15, revenue from contract with customers, performance obligation, going beyond one accounting year, construction contract environment. We've looked at IAS 37, provisions, contingent liabilities, contingent assets, and then IAS 41, agriculture. And so on our next session, that will be on Wednesday, make sure you stay connected and then join the session as well. 4:30 p.m. or 16:30 GMT, we will meet again and continue with our discussion. Remember, as I mentioned, we are in week 5 for the ICAG November 2025 examination. Registration is still ongoing. You can register. Our videos are recorded and accessible, and so you can register, get access to our summary videos, go through the course in record time, get access to our practice questions, and be guided and be assisted so that you can go into the exam hall, write the exam with confidence, and pass the examination. Also, we have our books available from public sector, taxation, management accounting, audit and assurance, financial reporting, corporate reporting, strategic case study. We have all these books available. You can reach us 050-114-9296. The number is below the screen. And whatever you need, you'll be assisted so you can get it. Remember, if you are going to sit for the examination, please don't be a lonely wolf. Don't try to be on this journey alone. Don't try to say, I'm going to do here a little, there a little. No. Reach out. We can help you. Let's make this journey interesting for you. Let's hold your hand, give you the blueprint, provide you with the assistance that you require so you can go into the exam hall and pass the examination. There are many people who get to the exam hall and they are freaked out because what they learned and what they are seeing in the exam hall is two different things. Yes, it's because you want to be on the journey alone. But if you want to be guided so that you are shown, okay, these are the topics. This is how the examiner is going to be setting the question on these topics. These are the things you have to be on the lookout for. These are the areas you have to focus on to optimize your chances of passing the examination. That guideline you need, and that is what our community offer and many more to help you so you can write the exam with confidence and most importantly, pass the examination. So thanks for watching. Thanks for sharing the likes. And if you have not subscribed also, make sure you subscribe to the channel. I'll see you same time on Wednesday as we continue with our discussion of the IFRS Masterclass, solving questions and crystallizing some of the principles we need to understand in financial reporting and corporate reporting. Take care of yourself, and I'll catch you on Wednesday as we continue with our discussion.